Hey everyone, welcome back to the channel. Today we're taking a deep dive into a fascinating topic in the history of global economics, the four major monetary regimes. These systems have shaped how we trade, invest, and value money, and understanding them is key to grasping the evolution of the global economy. Let's break them down. We're going to talk about four significant monetary systems: the classical gold standard, the Bretton Woods system, and finally, the flexible exchange rate system. Each of these regimes played a unique role in shaping the global financial landscape, and understanding them will give you a solid grasp of monetary history. Let's jump in. First up, we have the classical gold standard. This system emerged in the 19th century and was in full swing until the early 20th century. Under this system, the value of a country's currency was directly tied to a specific amount of gold. This meant that for every banknote or coin in circulation, there had to be a corresponding amount of gold held in reserve. The biggest advantage of the classical gold standard was that it limited inflation because the money supply was restricted by the amount of gold available. This helped maintain stability and confidence in currencies. However, there were drawbacks. It was hard for governments to adjust the money supply during economic crises, and the global economy had to rely heavily on the availability of gold. Next, we have the gold standard, which was a more formalized version of the classical gold standard. While the classical gold standard was more about each country individually linking its currency to gold, the gold standard established an official international system where nations committed to convert their currencies into gold at a fixed rate. The gold standard was used by many major economies, including the United States, the United Kingdom, and France. It worked relatively well during the 19th and early 20th centuries, but it had one major flaw: it was rigid. During times of war or economic stress, countries couldn't easily adjust their money supply, which sometimes led to deflation or economic stagnation. By the time World War I and II came around, the system started to unravel, as many countries suspended gold payments to finance the war effort, ultimately leading to the collapse of the gold standard after the Great Depression. Fast forward to the aftermath of World War II, and we enter the Bretton Woods System. This system was established in 1944 at a conference in Bretton Woods, New Hampshire, where leaders from 44 nations came together to create a new global economic framework. The key feature of the Bretton Woods system was the creation of a fixed exchange rate system, where the US dollar became the central currency, linked to gold. Under Bretton Woods, the US dollar was pegged to gold at $35 an ounce, and other currencies were pegged to the dollar. This allowed for greater stability in global trade, as countries knew exactly how much their currency was worth relative to others. However, by the 1970s, the US faced economic challenges, and the pressure on its gold reserves led to the abandonment of the gold peg. In 1971, President Nixon took the US off the gold standard, effectively ending the Bretton Woods system. Finally, we have the flexible exchange rate system, which we're living under today. In this system, currencies float against each other, and their value is determined by supply and demand in the global markets. No currency is directly tied to gold or any other commodity. The value of currencies fluctuates based on factors like interest rates, inflation, and international trade. The biggest advantage of this system is its flexibility. Central banks can adjust interest rates and money supply to respond to economic conditions. However, this system can also be volatile, with currencies sometimes swinging wildly in response to changes in global markets or economic policy. Today, most countries, including major economies like the US, the EU, and Japan, operate under this system. It gives governments more tools to manage their economies, but it also means that global financial stability is more reliant on market forces than ever before. So, to recap, we started with the classical gold standard, where money was backed by a fixed amount of gold. Then we saw the gold standard, where countries pegged their currencies to gold. After that came the Bretton Woods system, which tied currencies to the US dollar, and finally the flexible exchange rate system, where currencies float against each other based on market conditions. Each of these systems played a crucial role in shaping the global economy, and understanding how they evolved helps us make sense of the financial world we live in today. What do you think? Do you believe a return to a gold standard could benefit today's economy, Or is the current system better equipped to handle modern challenges? Let me know your thoughts in the comments below. Thanks for watching. Don't forget to like, share, and subscribe for more in-depth content on economics and global finance. I'll see you in the next video.